All right, so I guess we can start up. Kindly confirm you can see my screen. Please confirm the chat box that you can see my screen. Oh, great. So let's move on then. All right. So we're preparing ourselves for the new trading week. I've been in this industry for 3 years. I believe you also know traders spend looking for we spend dozens and dozens of hours. 1 minute, please. All right. So we spend several hours. We spend several hours trying to fine-tune our strategy. We spend several hours trying to fine-tune our strategy, and sometimes we try to beat the strategy to suit a particular pair, right? If you stayed long in this industry and maybe either code, so you tried optimizing P4 or some other optimizer, particular ways to fit into a particular. I've tried that quite several times, and what happens is that I try to fit a strategy. Either if I'm using stochastic, for instance, I try to tweak the data, right? If I'm using RSI, I try to tweak some of the data there, maybe RSI 7, RSI 14, you know, and sometimes it works very, very well for CAD CHF, right? Especially when you optimize on MT4, it tells you, you know, it gives you certain parameters you could use to optimize the EA. And after optimizing the EA into the data, maybe the data of just 2 or 3 months, I now try to run the same optimized EA on the same pair, but this time maybe I download more data and I'm now running it over a period of 6 months or 1 year. The result changes. I'm forced to optimize again. And as I optimize and finally I get satisfied, I apply that optimized EA or strategy to a different pair and then it crumbles. So for CAT CHF, the curve is smooth, right? An ascending curve, very minute pullback. Then I apply the same thing to Euro USD or GBP USD, and then it throws money away and blows out the account in less than 2 months. And it is, I've done several, when I mean several, I've done several, over 100, trying to find the holy grail of a strategy. Which is why we're trying to have this discussion tonight. There is a mental analysis that people do not do. We do technical analysis. We do fundamental analysis. We don't carry out emotional analysis. And what kills traders the most isn't the strategy. The strategy has of course, for you to be profitable, you should have a strategy that has a winning edge. But if you give a very sophisticated tool to somebody that is not learned, like we say, a weapon. So emotional control is critical, will be lost, right? Even the best technical analysts will be wrong, or lost. Technical analysis is one way to make money. It is not a guaranteed method. Yet, as retail traders, we treat this as if it is guaranteed. And there are many people who don't do well with it. The difference between successful traders and unsuccessful ones is their attitude towards trading, which is their mental attitude, which is what we want to look at today. We just summarize it in some few minutes, and perhaps we might just look at 1 or 2 charts and call it a day as we prepare for the week. If you're like me, I traded today. The market was so choppy. I barely went out with about 0.5% drawdown, basically. So a trader who is grounded in the market understands that he can't control everything. In fact, if I would paraphrase or retweak this particular statement, I'll say a trader who is grounded in the market understands that he can't control anything except himself. A trader the only thing you have the power to control is yourself. You can't control what price will do. You can't control when price will move. You might be right that price is going to go bullish, but you can't say it's going to move during the London Q zone, the New York Q zone, or even the Asian session. You can't do that, right? A trader who is grounded doesn't get upset if a trade doesn't work out, but moves on to the next one without looking back. That's the mindset we need to have this week as we move on. You don't need to get upset. So like someone in Simply Put today mentioned, he lost some money and he's feeling down. When you are still at that level of feeling lost and feeling down, when you lose, you are at the base level of trading. And you see, this trading is like a pyramid like this. There are several persons at this base level. They've heard how you could make money off trading. They've heard so many things. They've heard of people who made a lot of money, like in crypto recently. Many people came in at the peak and price dropped, and then they sold off at a loss rather than holding on, right? So, but as you stay long and stay the more in trading, your knowledge and understanding begins to improve until you get to the peak of that pyramid. And one of the things that need to grow is that you don't get upset when you lose a trade. When a trade doesn't work out, you don't get upset. You just move on to the next one without looking back. Like Mark Douglas would put it, every trade is independent. The outcome of the next trade has nothing, absolutely nothing to do with the outcome of the previous trade. Because you took a trade and it went positive, doesn't mean the next one is going to be positive. And if the former one was negative, doesn't mean the later one will be negative. The average trader has an unhealthy mindset and wants validation from his trading. He puts too much pressure on himself to be right about trades, which leads him to hold on to losing positions and take profits prematurely off of winners. This ultimately results in more losses for him than wins. Now, if we have webinars and we say we want to analyze a strategy, we'll have like 100 persons online. When we say mindset, we get few people. Why? Because many people don't think mindset is important. Yet, this statement here is what destroys a lot of accounts. If you follow Mark Douglas, he stated clearly there that there is the euphoria of winning and the pain of losing. For most people, the euphoria of winning, even if it was once, 2 months ago, we carried them through several losing trades, hoping that sooner or later, they're going to have a winning trade, right? And that keeps them in a cycle. And what eventually destroys the account is that they are waiting for the trade to validate them. Your trade cannot validate you. You validate yourself before coming to the chart. You validate yourself before coming to the chart. You don't come to the chart to seek validation. The market does not know you are there. The market is not hunting you. If you take GBP JPY trade, if it's going to go 100 pips in a sell, it will go 100 pips in a sell, whether you took the trade or not. If you decide to go on 2 weeks yoga leave and disappear, if GBP JPY was supposed to hit 100 pips sell, it's going to go 100 pips sell, whether you are there or not. So the market doesn't know you are there. You don't seek validation from your trade. You have a trade lineup, a setup, and then you go after that setup based on your trade plan, right? If you wait for validation from your trade, you want to be right at all costs. And what will that bring? It will make you to hold on to your losing position. And because you want to satisfy your mind that you are actually winning, you will take profits prematurely, only to come back and price would have gone several pips in your direction, but you took profits prematurely, and then you held on to your losing trade. Such an account will eventually go extinct, and there's nothing you can do about that. Right, so traders need to transcend fear. All professional traders transcend fear. Traders are afraid of 4 things, basically: being wrong, losing money, missing out on opportunities, which is FOMO, and then leaving money on the table. I know that most of us understand the first 3. Being wrong, losing money, missing out on opportunities, fear of missing out, FOMO. The one most people don't really consider is leaving money on the table. Most traders don't want to leave money on the table. If you want to be a professional trader, you must be willing to leave money on the table. What does it mean to leave money on the table? It means that you've done your back test and your trade plan says you should go for 1:3 risk reward ratio. right? That's what your trade plan gives you, a 1:3 reward ratio. So you finally found your prophetic candle, you've drawn your AQZ feed, and you are going long. You're going long, 1:3 has to be here. Take a profit and take a walk. It goes 4,000 pips thereafter. So if you leave sorry about that. My connection went off halfway. Hopefully it settles down and we can proceed. All right, we won't stay long tonight. Okay, so like I was saying, what most traders don't consider is the base effect on traders. So you see traders going to Telegram groups and several trading social media groups to boast about the 300 pips they caught, the 400 pips they caught, and the 1,000 pips they caught. The question is that in your trade plan? If 1,000 pips is not in your trade plan, you have just solidified your means to failure. You have to be mechanical when trading. You have to be strict with yourself when trading. You have to have a systematic way of taking profit out of the market. And that includes leaving money on the table. Let's say I've given you an example of someone whose trade plan is a 1:3 risk reward ratio. When it hits your 3% reward, you take your profit and take a walk. Now let's look at someone who doesn't have a 1:3 risk reward ratio, or someone who has a trailing stop loss trade plan. So let's say your trade plan is that I'm going to enter 2 trades, 2 entries per trade. So if I have a trade for GJ and I'm supposed to risk 1%, I'm going to enter 2 trades at 0.5% each. Once I hit 1.5%, I'll close the first trade and move my stop loss to break even for the second trade. Right? Now, remember the second trade will be at 1.5% itself too. And now your trade plan says for every 1% extra moved, I would trail by 1%. So when price moves 2.5%, you trail by 1, and you're leaving 1.5% in the market to allow for swing lows and swing highs. What you have done is that you've left 1.5% money on the table, because price could easily come back, start you out at 1%, and now you would have given back 1.5% to the market. Any trader who doesn't want to leave money on the table is on his way to blowing his account, because you will be insisting that you are capable to look for the top and the bottom with razor sharp precision. And that is a recipe for total failure. Right? So these fears could often dominate trading decisions of several traders, and they can't see situations of opportunities accurately. They act objectively and feel immobilized. The source of these fears is not the market, but rather a trader's attitude towards life itself. This is difficult for most traders to perceive because it requires an honest assessment of themselves, as well as an understanding about why they trade in the first place. You are trading in the first place not to prove to the market that you are right. You are trading because you want to take a fraction, a minute fraction out of the trillions moving on in the market. And when you take your own fraction, you are to win everything. To win everything. You're in the market to take a little out of it and take a walk. I'll give you a good example of what happened to me recently trading crypto. Right? I bought Ethereum when Ethereum was still a little below 600. And I bought BNB when BNB was 48 and $58, right? I rode BNB to well over $600. That is over 11x. And I rode Ethereum to when Ethereum got to $4,350. Now, as price was going, I was taking profit, and I left some profit, some trades to run. And when price pulls back, I will buy and move. That was easy for me to do with BNB. But Ethereum, at a particular point in time, just became parabolic, and it didn't give a re-entry. It just kept pushing up and kept pushing up and kept pushing up without giving a re-entry. It finally stalled somewhere and pulled back a little. I was anticipating that it will hit $5,000. So I entered a long position again at 4,100, anticipating that it will break the all-time high of 4,350 and then head towards 5,000. And then what happened? It broke down. It broke down so far, so far that, of course, I didn't use stop loss when I was trading because I was hodling. It broke down so far that I got so upset with myself for losing that much, even though I knew that I wasn't supposed to buy the top. I was supposed to wait for a pullback because it's imminent that there will always be 20%, 30% pullback in this market. So what happened? Now I'm down over 30% from my point of entry. What decision should I take here? That was when it dawned on me that even though I had a trade plan for a bearish market, I had not revisited that plan for over 6 to 7 months. And because I had not revisited the trade plan for a bearish market, I was indecisive as to what to do with the bearish market. And I left this transaction to plunge down to 1,700. I could easily have closed this out at 3.8, and then when it came back to 1.7, I could have bought more and then held on for it to move on. Right? So when you allow fear to come, added with some other things, you have this feeling of being immobilized. You have this feeling of being immobilized. So you see traders taking a trade, and the trade is heading towards their stop loss, eating their equity, and they'll just close the empty for. Say, look, if you want to take all the whole money, take the money and let it go. You just give up on your equity. You surrender your equity to the market. Do I have a witness here? Do I have a witness? Has it ever happened to you? You get you get so angry at yourself that surrender the whole equity to the market. Anything you want to do, just do. I'm tired. It happens very often. The reason is because we have not learned to conquer our fears. We've not learned to conquer our fears. And listen to this: if you don't take deliberate action and deliberate steps to conquer your fears, you will remain in them for years and years on ending. It has to be a deliberate step. The market will not give us profit on the platter of gold. we have to wrestle it out of the market. We need to wrestle it out of the market, right? As we proceed, you see how AQZ makes all of this very, very interesting. Let's move on. Right, so trading is risky, and there's no doubt about that. And we need to allow that thinking. So most people come into trading or if they know it is risky. There's a difference between knowing something and understanding something. For the religious ones amongst us here, everybody knows that God is everywhere, but some people still hide somewhere to commit sin. There's a difference between knowing and understanding. You could know that trading is risky, but do you understand that trading is risky? If you understand that trading is risky, you should know that you should have a trade plan, a checklist that you tick off, like somebody who is a pilot in the cockpit and is checking, have I done this check? Have I done this check? Have I done this check? Or somebody in the lab who is supposed to, do an analysis on a very contagious and very risky parasite or pathogen or whatever, and he needs to do, the checklist of the fact that he has all the PPEs on before going into, the quarantine area, structured in such a way, like it do recently, right? So many people blame Elon Musk. Elon Musk had nothing to do with it. The market was just ripe for a pullback, while several people had made millions and thousands of dollars, and they felt it was going to be like that, and they let lose their guard, and the market took everything back. Trading is risky. It is hard to make money. And if you've been following us in Simply Peace, you would have heard me say, trading is a hard way to make easy money. It's a hard way to make easy money. It is hard to make money. And even if you do, there are no guarantees that it will stay with you. Even if you make money from trading, there is no guarantee, which is why it is futile and almost short of stupid to flash your results in Telegram groups and WhatsApp groups. Yes, you made the money today. Are you sure you wouldn't lose them tomorrow? Are you sure? You could lose everything tomorrow. There are no guarantees in this market, right? So the way people think in everyday life doesn't work when we're trading, because traders have to deal with constantly with the inherent risk of trading, also while dealing with their own emotions, right? If you are able to conquer our emotions while handling risk, then we become profitable traders. But until then, we are people who just play with our MT4 and excite ourselves with technical analysis. To be profitable, you have to be able to deal with your emotions and at the same time do this while handling risk. So trading is a risky business, but that doesn't mean you are taking risk. Because it's a risky business doesn't mean you have to take the risk. It just means you need to accept the consequences of your actions and take your actions knowing fully well that some trades won't work as planned. Not all trades work as planned. That is the risk involved. If you are a professional trader, you have a trade plan that gives you an edge and gives you an estimate of your win ratios. If you're a gambler, you don't need a win ratio. You just click on buy and sell at impulse simply because Bishop or Dog or somebody else mentioned buy GU. You just jump in with Lambo lot sizes, hoping to kill the market and wreak havoc on everybody. But a professional trader will ensure that for every trade taken, irrespective of who calls the trade, follows a particular pattern. I've said it before that the largest losses I've had trading were times I took trade calls from my mentor. I lost the most. Because it was my mentor that gave those trade calls, I was so positive that I use bigger than life lot sizes. And of course, your guess is as good as mine. What happened to my account? Right, so let's wrap it up. This should be like the last slide before we go into how AQZ makes all of this sweet for us. One of the things we must fight against this week is addiction to random rewards. When you give random rewards to monkeys, it has been proven that they will repeat the task in order to receive those rewards. If you stop giving them those rewards, then they won't perform the task anymore. And Mark Douglas gave us a very good example with this in his book, Trading in the Zone. So if you have been trading the last 12 months, 13 months, 24 months, hopping from strategy to strategy, and there's no problem having 2 or 3 strategies to trade with, but you should have a trade plan for each of them. So if you've been trading them haphazardly without actually being dogmatic and being systematic in taking the trade, you would be like a monkey who's been rewarded for being stupid and then decides to continue to be stupid with the hope of being rewarded. And this market is notorious for rewarding stupid things. If you wake up every morning and tell yourself, if I wake up and my face is turned to the right-hand side of my bed, I'm going to buy GU. And if I wake up and my face is turning to the left-hand side of my bed, I'm going to sell GU. I can guarantee you that there's every likelihood that you have some winning trades out of 30 trades. And your analysis was just the direction of your face when you woke up. No other analysis. The market will once in a while reward you. If you get addicted to that attitude, you might need a psychologist to break you out of that. Because you will learn every strategy, know them to the T, but find it very difficult to work by them, to apply them. And once you get to that level, seriously, you need a senior mentor to help you. Because you can learn any strategy, including AQZ. You find it difficult to work by that strategy. And I know there are some people like that here. You're addicted to random rewards. You've grown accounts and you've shared the results everywhere. And when you are asked, how did you grow the account? You say, I don't really know. When I just see price moving, I just enter. When it moves, I just trade. And come out. You have no strategy. Your strategy is follow the candle. And now you've lost everything. And it looks like you don't even know how to follow the candle again. Like we say, African proverb, that even a broken clock will be right 2 times a day. But that doesn't mean the clock is correct. We need to take responsibilities. Traders are part of the market, so you shouldn't judge the market that the market is good or bad. I traded today, I lost 0.5% of my account. Well, the market range. The market range. And I'm part of the market. If I feel I need to move the market, then I should pump it 2 trillion. If I don't have 2 trillion, then I wait for the big guys. As simple as that. All right, let's jump down quickly. How do we react to losses? Successful traders have a good understanding of the idea that trading is about probabilities and not individual outcomes. So they commit themselves to making trades that conform with the definition of an edge. They eliminate from their universe any potential damage caused by unrealized expectations and instead focus on the big picture. So when they lose 1 or 2 trades back to back, they don't have to go back to the drawing board to change the strategy. They've done that prior to this time. They discovered that they have a winning edge. A casino will not go and change their trade plan simply because 5 of their machines hit jackpot on a particular day. Let it hit the jackpot. The casino has been skewed in such a way that the house will always win. If you use an asymmetrical risk-reward ratio of 1:3, you only need to win maybe 3 trades out of 10 to be profitable. If you take 10 trades and you lose 7 times, you would have lost 7%. If you win 3 times out of 10 and your risk reward ratio is 1:3, 3 times 3 is 9. Your account will be up 2%. So why should you react to 2 losses? Why should you be emotional about 2 losses when you know that with 3 wins alone, you could be profitable? What is 2? What would 2 losses do to you? Professional traders don't react to losses like, I'm tired of this life, I need to go look for another business, maybe I should consider poultry or fishery. That doesn't mean everybody who attempts trading will end up becoming a trader. Some are just better off being, a trader, but maybe a trader in some other things, not forex. So thinking like a trader, trading can be described as a numbers game where we look for patterns and determine when to take profit. We don't dwell on past failures or become emboldened by success streaks. We don't do that. We don't use 1%, and because we had 5 winning streaks, then we increase the next trade. We now, instead of risking 1%, then we just go straight up and risk 3%. This 3% could be a loser, and then you would have gulped up majority of your wins, right? So how does AQZ help us with this, right? How does AQZ basically help us with this? In AQZ, there are very fixed rules, right? Very, very fixed rules, which is why I push AQZ now as against the traditional BTMM. The traditional BTMM, very good strategy, I must say. I'm not saying it's not good, but the rules are just too numerous that it becomes, you have to check for blood in the water. I know here now. You have to check for shark fin, you have to check for you. Humans are inherently, they need something to actually push us beyond normal. All right, sorry, I'm back now. Okay, so how does AQZ help us with this? AQZ has very fixed rules, very, very fixed rules, and there's no point complicating something that simple, right? So someone said today, simply put, you guys are not posting signals again. It becomes difficult to post signals when everybody knows what the bias is. When I call up G, it's very easy to know what the bias is. Look for a H4PC, put your feeds. What other signal do you need? Right? And we did this in a selfless way. Most groups would want to keep you coming every day, behaving like they are giving you a holy grail of a strategy. Yes, your account can't really go. So AQZ has very fixed rules. It is our duty, you and I, to go understand what prophetic candle is, what prepared entry is, what the aqua zone is, what the roadmap is, what invalidation, revalidation, and violations are. Very simple rules. If you like using stochastics with them, TDI, so be it, but you could trade it as a pure price action. And AQZ doesn't say you won't lose, which is why we have violation. The very fact that there is the term violation or invalidation simply means you get to lose sometimes, which is in tandem with the real life scenario in trading. You get to lose. But we know that the possibility of winning back our profit after we have lost is high. So when we lose, we simply go to the next. I'll give you an instance of USD card today. I took USD card today. Let's go to H1. Let's go to H1. All right. So here, I took USD card today for a buy of this H1 prophetic candle. It went, hit my SL, and then went ahead to hit my take profit. Right? Then I decided to go short. And it's heading towards my TP. These two trades are 1:3 risk reward ratio. As it is presently now, I'm in profit. I lost 1% in this trade. And here, I should be like 2% off. I'm in profit. Let me see. Let me be sure. Where is price now? Take the magnet out. All right, so if I'm to look at where price is presently, this is 1.65. I lost 1 for 1, and I'm in 1.65. I'm in about 0.65 profit. There are days this will be 2 or 3 losses back to back. But if you have a 1:3 risk reward ratio, you could stomach your losses over and over. You know that 1 or 2, 3 back-to-back wins will erode every loss that you've made and become profitable for you, right? Sorry, let me pull this back to be sure I'm keeping in tandem with my straight line. Yep. Right, so as we round up, we shared this Excel sheet with everyone here, and I'll keep repeating it until it sinks down for so many people. This, I've explained already, the importance and the power of asymmetrical risk reward ratio. Asymmetrical simply means that your risk is not proportional or it's not equivalent to your reward. Your rewards are higher than your risk. So if you're risking 1 part, which is the 1% or 0.5% of the account, it should be because you're looking at making something, let me use the mathematical term now, something greater or equal, no, not something equal, something greater, right, than 1. You should be aiming for something greater than 1 as your reward. And typically, I suggest a 1:2 at minimum, and then at an average, 1:3. And I must tell you the truth, trading Forex is becoming more and more difficult. Statistically, Forex pairs range over 70% of the time. But outside Corona, when the markets were plunging in one direction, if I'm to take the statistics from April last year to now, a little over a year, most pairs range over 80% of the time. Over 80% of the time. So it becomes increasingly difficult for you to find a 1:5 risk reward trade, except you have to you're narrowing down to 15 minutes or 5 minutes for your entries. It's becoming difficult to get those massive risk reward ratios. I'm not saying you can't get them, but after getting one, the next one will be far apart. It won't happen like every other day. So a 1:2 or a 1:3 risk reward ratio is still within reach. So let's look at this template here. It's for a 1:2 risk reward ratio. You know you will lose which is what I'm trying to say for this week. I'm preparing our mind for this week. Go out and face those losses gallantly. Accept the losses as part of the business. Don't crumble because you have 2 losses on Tuesday morning. And then you close your MT4 and walk away only to come back, and now you've missed out on massive moves that would have recovered your profit because you allowed the market, the losses to get at you. No strategy will stop you from losing. If there is, that person should be richer than anybody on the face of the earth now. If you use an asymmetric compounding, not just asymmetric, asymmetric is normal 1:2, 1:3. But if you use an asymmetric compounding risk reward ratio, let's look at a scenario, this scenario on the screen. This trader had a 36% win rate. Out of 25 trades, this trader won only 9. Only 9 trades. And that became 36%. At the end of 25 trades, this account grew by 6%. And in the lifetime of this account, there were times when this account was up 11%. The maximum drawdown this account was a negative 3%. Why? This person is using an asymmetric compounding risk reward ratio. Let's randomize this again. Right, notice this time the win rate is slightly higher, 44%. After 25 iterations, this person had a 4% growth, but somewhere in between the lifespan of this 25 trades, the person had 14% profit. Now, I'm trying to bring out 3 things from this iteration. First is that we mentioned that because you made wins yesterday, doesn't mean the wins will remain with you tomorrow. This account was up 14%. After 25 trades is down, it has lost 10%, and the account is just up 4%. But it's still a winning trade, which is why we propose things like FTMO. So that when you make your winners, you simply withdraw them and start again, and don't give it back to the market. Like we'll be tempted to do if you're trading your personal account. You want to grow it and compound it. Your wins could disappear. I mean, it's part of it. Second thing we want to see here is the number of back-to-back losses that you could incur and still be profitable. The iteration in front of us, for instance, after the first winning trade, had 4 back-to-back losses. 1, 2, 3, 4. Then has 3 back-to-back losses. And the account still grew. Right? Most traders shy away from losses. And some will refuse to take profits after 1:2, simply because yesterday, after they took profit at 1:2, price went for 1:7. And now today they expect it to go for 1:7. Wake up, guys, for that Christmas only exists in cartoons. In real life, you don't take your profits, the market will take them back. And now you'll be shouting, buy the dip, buy the dip, buy the dip. You had time to take your profits. You didn't take them. One more iteration. Now watch this. 40% win rate. And this account at one point in time had an 18% growth. It ended up with a 5% growth at the end of 25 iterations. And I put it to you, we are 36 people here. If I put a pool on, I am very, 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 very confident that less than 2 or 3 people can bring proof to show that they've grown any account by 5% 2 months consecutively. Very few people. Right? With this method, you could. Again, watch this. This trader that grew an account to 18% at one point in time ended up at 5%, had 1, 2, 3, 4, 5, 6, 7, 8 back-to-back losses. 8 back-to-back losses. And the account was still profitable. So when your mind tries to play prank on you and let you feel like this strategy is wrong simply because you had 8 back-to-back losses, it's very possible to have 8 back-to-back losses. You are supposed to have 8 back-to-back losses. You are supposed to be ready to have 10 back-to-back losses. Now, this is a 1:2. Can we look at a 1:3 risk-reward ratio probability system? This is a 1:3 risk-reward ratio probability system. In this case, this person grew the account, had a 52% win rate, and the account after 25 trades grew by 54%. Right? Let's randomize this again and see if we can have a very abysmal return. Right? So again, a 40% win rate, less than average, and the account grew by 24% after 25 trades, and sometime within the lifespan of these 25 iterations, the account witnessed a 34% growth. Let's do 2 more times and see how it turns out. Right, so let's see this. A 48% win rate, the account grew by 41%. Notice the maximum drawdown here, -5. This account still had back-to-back losses. In fact, the very first 4 trades that this trader took were all losses. The very first 4 trades were losses. For most people, this is a TKO, technical knockout, and they will never ever return to that pair or return to that strategy again. 4 back-to-back losses on my very first attempt, the devil is a liar. And they will just run away. Right? I'm looking for a situation where we'll have several back-to-back losses. I'm looking for a situation where we'll have several back-to-back losses before we call this a wrap, guys. Oh, this is a 52% win rate and a 1:3 risk-reward ratio. This account grew by 72% after 25 iterations, which would be like a month or 2 months, right? Depending on what time frame you're trading. Right? I want something with an abysmal, right? So let's see this. Let's see this. This is a very bad month, a very, very bad month, or a very bad series of weeks. It could be 8 weeks, 24% win rate. 24. I mean, this guy won only 6 trades out of 25. The account only witnessed a marginal loss of 4%. And in fact, at some point in this account, it had a 10% profit. I believe with this, I've been able to prove to you guys that accepting a loss is mandatory if you must be a professional trader. And if you must make trading a source of livelihood, you must be willing to accept a loss. You must be willing to ensure that a loss does not change your psychology, change your mental health, your mental framework. You must be willing to take the next trade without hesitation. Quoting Mark Douglas, if you get another setup, take it. It invalidates. It gives another setup, take it. Doug did a very good. Oh, I wish I had prepared that. I would have brought out that example. I think it was last week, Thursday or Friday. He was trading gold, and this was his setup, and it invalidated. He went the other way. It revalidated again. He went the other way and made his profit. But when you give up, you come back 2 days later and price retested PE and moved 5 CPs, but you were not there simply because you had 2 losses and you went back to crawl under your shelf. You must accept the losses. This trader had 1, 2, 3, 4, 5 back-to-back losses. That was upon the heels of another 5 back-to-back losses, which was followed by a series of 2 back-to-back losses, and finally ended with 3 back-to-back losses. You should also see the futility in flashing your results. You could have an 11% growth and end up the month with -4. You could do that. The market could do that. But if you look at the long you know, the bigger picture. Look at the bigger picture, right? The next month could just be this sweet, even at the 36% win rate. Right? Yeah, Mr. Sadiq, you want to ask a question? I can see you've been trying to raise up your hand.
Yes, sir. Good evening, sir.
Good evening. Go ahead, please.
Yeah, you were saying something. You said something very briefly about FTMO, that as you are making your profit, you can be withdrawing it instantly instead of you keeping the money there. I want you to, maybe if it is just 5 to 10 seconds, you should rephrase that part again, sir.
All right. I don't mean you take your money instantly. You are paid after every 30 days, 30 days from the day you started trading, right? But there is a path in FTMO where you could compound. You could decide to leave your profit. They will take theirs. They don't wait for you. They will take theirs. But you could decide to leave yours just so you could grow the account. If you have some months back-to-back wins, they will increase the balance for you on their own. Right? So
thank you very much. That answered my question.
Make your profit, withdraw them, guys. Make your profit withdraw. The market can always take back what is given to you.
Yeah, thank you very much, sir.
So ladies and gentlemen, welcome, bro. Let's go into this week not afraid of losing. It can be very detrimental. I agree with you. It can be something. It can be, but I mean, we can't run away from it. So we better just accept it and then move along. So let's continue discussion on Telegram. Hopefully, I'm hoping that by Wednesday we'll have one of us, Ifraz, to start taking us on the basics of volatility. Right. So let's see if we can trade volatility index. I learned it's a little bit more straightforward than Forex. I know very little about it, so I would really want to anchor what I don't know about. So we have some family members amongst us who have been trading this for some time. They will anchor and we'll learn from them. That will be Wednesday, 9 p.m. Basically. So let's see who are the people in attendance. For those of you in the fostering class or who have passed through a fostering class before, whichever section you are, we have a meeting tomorrow. I think I've dropped it in the group. Let's plan to attend. Right, guys, have a wonderful night and enjoy your preparation for Tuesday. All right, bye-bye.